Hello and welcome. My guest today is Hemant Daga, co-founder and CEO of Neo Asset Management and ex-CEO of Edelweiss Asset Management. He has with him close to 2 decades of overall work experience, and he's also an alumnus of IIM Bangalore. Hemant, welcome to this show.
Thank you, Nitin, and thanks for inviting me and to this episode with you.
Thank you so much. It's always a pleasure talking to you. Now, first, let's start with your career. You have had a very successful career spanning over 2 decades now. Talk us a little bit through how that journey has evolved. And one of your specialities that I can see is really the underwriting of credit. And it would be lovely to hear from you of how you actually built the capabilities around it.
Sure. Interesting question. So, when I started my career, I started as a trader, trading currency markets, had the pleasure of trading global currencies, had the pleasure of trading all asset classes in India. Did that for the first 10 years of my life and had a fantastic experience. The one thing that I learned, which a lot of people sometimes don't realize, Nitin, is trading is as much a science as an art. Yeah. And we focused on the science part of it. We made it a process, very, very repetitive process. And that's something which has been very handy to me in the world of investing also. After doing this for 10 years, I was also fascinated by the world of asset management. And I spent a lot of time reading what some of these global firms like Blackstone and Brookfield had done. So I read Brookfield's annual reports from 2000, year after year, year after year, and year after year. And they inspired me like anything. And I saw similar opportunities in India. That is when my career, I transitioned my career from trading to asset management. And this was in the year 2017. So in 2017, obviously, I had the privilege of heading the asset management business at Edelweiss. And I had the privilege of doing both the mutual fund and the alternatives business. The good thing is, when I read so much about Blackstone and Brookfield, I think India was just so early in these asset classes. What they had done in the US for 25 years, if you look at their returns, it's absolutely stellar. 15% dollar compounded returns. It's envious, it's inspiring. And that's what we want to do, and that's what I wanted to do. These are large asset classes. Credit is as large an asset class as it gets. It's even bigger than equity markets. I think now what we are doing on the infrastructure side, I think these guys have done that in countries like Brazil, Australia, US, at a scale which is unbelievable. And that inspired me. Yes, I think 2017, I think the learnings have been amazing. I had the fortune of managing more than 50,000 crores of credit and alternative assets. And that too in a period where India saw 9 sigma events in credit, Nitin. You had demonetization, which from a credit perspective was a 9 sigma event. Yes. You had ILFS, DHFL liquidity crisis. And on top of that, you had COVID. Yeah. And I jokingly told a lot of people, I think this 50,000 crores of credit assets condensed into 4 years is equivalent to maybe 2 lakh crores of credit assets spread over 20 years.
Very true.
And a lot of the learnings that happened, how should you approach credit as an asset class? And fundamentally, some of the biggest learnings that we had in this journey, I think in the business of credit, what matters is the most important thing is counterparty.
Absolutely.
To whom are you giving money? And as investment managers, as asset managers, when we are custodians of money, I think doing thorough diligence on whom you're lending money to, what is his intention? In Hindi, I jokingly call it niyat, and I think that truly matters in the business of credit. The second most important thing is keep it very simple. I think sometimes people use a lot of jargons like, PAIC, redemption structures, back-ended structures. I think just keep it very simple. Do lending in cash flow-led businesses. We are in the business of asset management. We are not in the business of running businesses, right? Our businesses in which you do credit should generate cash flows. They should be EBITDA positive companies. As an asset manager, my value add comes in changing the capital structure, providing capital at the right time. And at Neo, we joke, many times, at least in the business of credit, 80% of the problems can be solved by just putting money at the right time. Because at that time, your incremental return on capital can be as high as 50 to 70%. And that is the secret sauce. So putting money and the act of putting money itself is invaluable. So keep it simple. Find businesses which require money at the right time. There are a lot of businesses in India like that. And focus on cash flows. Regular paying structure so that your risk reduces over a period of time. In the business of credit, you need to reduce your risk over a period of time. You can't increase your risk over a period of time, because risk finally materializes when the borrower has to pay you money. And he pays you after 3 years, 4 years. At that time, your risk has to be lower than your initial risk, Nitin. This was a deep insight to me. It might sound absolutely commonsensical. And I fundamentally believe in the world of investing, everything is highly commonsensical.
True.
You know, we've been taught in textbooks, jokingly tell this joke to a lot of people. When you're in class 10, you're reading an ICSE book, it tells you buy at 13 PE, sell at 22 PE. In real life, it's difficult to practice it.
Right.
I think emotions get in the way of investing. In credit, it's very simple, lend to cash flow generating businesses. So my biggest learnings have been counterparty and cash flow doing businesses. Keep credit relatively shorter duration. Don't focus on things which are under construction. Don't do crystal ball gazing. It's a relatively simple business. Keep it highly, highly simple.
Right.
Yes, so that's been the journey, and yeah.
So the other part to what you were talking about is capabilities, right? So you're obviously there at the helm, but then you need seasoned people to look after, all that you are doing in terms of lending activity. So it'll be interesting to understand the capabilities that you've built on the credit opportunities side, and if you can help us with a few case studies for
Sure.
investors to understand the strategy a little better.
Absolutely. So this is a deep question and something very close to my heart. As I said, when I started my career, I was in the business of trading. A lot of people think trading is an art. You need smell to judge a great opportunity. I feel the opposite is true. You need science. It's a reputable opportunity. The world's best traders are actually made it a science. At Neo Asset Management, our philosophy on investing and asset management is twofold. Obviously, we will hire teams with deep specialization, teams who understand this space, have seen it for many years, and building a highly competent team is very important. But what is more important in our view and in my view are two more things, Nitin, and I would place disproportionate importance on them. In the business of investing, I think in any business for that matter, we fundamentally believe good investing is the outcome of healthy, open debates. And as an asset management firm, we encourage that. We encourage debates. We encourage multiple point of views. And that is when we get the benefit of collective wisdom.
Right.
The way we run our investment committees, there is a science to that also. And I truly believe, investment committees, I've sat in many investment committees. There is a chair who sometimes takes the decision. And at that point of time, you don't get the multiple views, the wisdom of collectiveness emerging.
True.
At Neo, what we've done is, and this is a very small change, but I think this is a big step. We do a blind ballot voting. Everybody who is part of the investment committee casts his vote, so that nobody influences the other's decision. And at that point, we see the outcome. Is it a unanimous vote? It's a very small change, Nitin, but from a behavioral point of view, I think it's a massive change in the world of investing. So I think what is required is getting an inclusive culture, healthy debate, and being very honest. I think a lot of investing firms, the holy grail of their success is when you see the outcomes in the mirror and you're not ashamed to highlight it to anybody. The third most important thing, teams, culture, processes. So a lot of the stuff that we do is common sense, and I want it to be common sense. We are not in the business of finding exotic ideas. We are not in the business of discovering new things. We are in the business of doing simple things really well. Processes play an important part. How you do your investment committees, pre-investment committee checklists. Is there a standardized way of looking at investments? Is there a way of standardized looking at investments after you've done the investments? So that we are people dependent and yet not people dependent. So And that's the way we want to run investments at Neo Asset Management. That's the way we think we will truly build an institution. It is not about me or Puneet Jain or Sandeep Khemka or Abhishek Goel, the senior people in our team. It is about Neo Asset Management in totality.
True.
Yes, so a long answer to one of your questions. The other question that you asked, Nitin, is can you provide some case studies to our viewers on the type of credit transactions that we do? Yes, so we've done 6 investments in the last 1 year. We've evaluated more than 180 transactions. 180 transactions, all EBITDA positive companies, which tells you the opportunity that we have seen. Fundamentally, I believe the more you evaluate, the better your chances of success, because then you can truly reject. Right? Rejection is a great weapon in the hands of an asset manager. Let me talk you through one. This was our first investment, so it's always special. It's very close to the heart. This was a fully constructed hotel in Ahmedabad city. It's called ITC Welcome Hotel. Many of you might have stayed there. Many of you will stay there, I'm hoping. This is on Sabarmati River, great location. So yes, location matters, counterparty matters, and first generation entrepreneur, he's built this, very simple man. Now, why did this opportunity? So this promoter was running the hotel. He owns the hotel, ITC runs the hotel. He was running the hotel, Nitin, from 2009 to 2019. In 2019, he went and did a JV with ITC. That is when ITC told him that you need to renovate the hotel. And he needed money for that. In 2019, the promoter went and took money from an NBFC. The NBFC gave him money, promised him that whenever in future renovation capital is required, I will keep giving you money. 3 years passed. Obviously, he had the misfortune of seeing through COVID. The hotel was getting renovated. But in 2022, when we met this guy, the NBFC told him that we've stopped doing this business as a corporate philosophy, and you now need to repay my money. Plus, I will not give you the balance money for renovation. And this happens in real life all the time, right? Yes. Now, here is a situation where this promoter could not have borrowed from a public sector bank or any other NBFC, which are the traditional channels of finance, which all of you and me associate with, right? Because a bank will typically not give money to give exit to another NBFC, right? Exactly. RBI as a regulator from a distance cannot distinguish whether it's a genuine refinance transaction or probably no, right? Which is why the opportunity comes to asset managers like us. We call this in our parlance a refinance transaction. So here is a great asset, very good. So let's just go with our framework.
Sure.
Counterparty, we were very comfortable with, first generation promoter, hard sweat, money earned, put in this project. Simple guy, we've done our diligence on him. And we typically do external fraud audit, forensic checks on counterparties also. That's how we try to make it a repetitive science. Right. So counterparty, we were comfortable with. Cash flow, yes, fully constructed hotel. We were not taking construction risk. As soon as the renovation was done, ITC was ready to kickstart the hotel. This hotel would generate 15 crores of EBITDA every year. So it's a healthy cash flow, 4.5 to 5-star hotel in a great location, in a great micro market, because Ahmedabad is a hotelier's market in that sense. Third is collateral. We were the only lenders, Nitin, in this transaction. Typically, we are the only lenders in most of our transactions. I think that's competitive edge.
Sure.
Collateral was worth 180 crores, 4 times the value that we lent. So we gave 46 crores. He repaid the NBFC. We are the only lenders. This is generating 4 times collateral cover on a marquee asset. Plus, it's making 15 crores EBITDA from which he will pay you cash flows. So it's tick marking all the boxes. Is it generating cash flows? Yes. Will we get paid from the cash flows? Yes. Is the collateral cover sufficient and enough if something goes wrong? Absolutely yes. Are we the only lenders? Yes. So this was the first transaction that we had done as part of the Neo Special Credit Opportunities team.
Lovely to hear that. And you're saying 6 transactions already done with. How many transactions could potentially be part of this fund?
So we endeavor to do at least 15 to 20 transactions in this fund. And this is one of the other learnings. I think in equity, as an asset class, one can run concentrated portfolios.
Right.
Obviously, there is a difference of view. You can run a 10 stock portfolio, 5 stock portfolio, you can run a 50 stock portfolio. But in credit, fundamentally, we believe diversification is super important.
Yes.
And the reason I want to highlight this, a lot of times when I meet clients, we tell them we are looking at delivering estimated gross IRRs in the range of 20 to 21%. The beauty of doing 20 investments is when you're so diversified, assume something goes wrong with one investment, right? And it can happen. I mean, to the best of our efforts, something can still go wrong. The impact on your portfolio returns, the drop from 21 estimated will be closer to 19 and a half. And that is what finally safeguards your portfolio.
Yes. Yes.
And that is very important to us, which is why we want to do as much diversification as possible.
Great. Now let's move to the new strategy that you have currently opened up,
Sure.
which is called the Neo Infra Income Opportunities Fund. And this is a mezzanine fixed income opportunity, which looks at infrastructure-oriented assets, predominantly in roads and renewables.
Sure.
Right? Now, this obviously is a combination of InvITs and SPVs with fully operational kind of assets.
Yeah.
But before we deep dive into what this means from an investor perspective, talk us through the opportunity and why this presents such an exciting investment for investors.
Lovely question. So that's where my love with asset management started, I would urge all of you, whenever you're free, read about this company called Brookfield Asset Management. It is one of the world's largest asset managers. Brookfield owns buildings in New York, it owns gas pipelines, it owns airports, it owns all infrastructure assets. Globally, if you look, asset managers own infrastructure operational assets. In fact, 45% of operating infrastructure assets the world over are owned by asset managers. Why should they be owned by governments? Why should they be owned by developers? Because their balance sheets cannot take longer duration assets, right? Very simple. When I was in school, very basic: invest for the long term, invest in assets generating stable cash flows, invest in assets that give you a hedge against inflation. Just go through all the tick marks. Operating infrastructure, we are not taking any construction risk. It generates regular cash flows. Where are the cash flows coming from? Government counterparties, and largely the central counterparties, right? Third, it is an inflation hedge. Plus, it is an asset for the long term. As an individual, I would love my assets to be parked in the long term, where I can earn steady cash flows and make great returns. So that is what fascinated us at Neo about this opportunity. This opportunity is so large that we are still very new to this opportunity. This is an opportunity it requires 8 lakh crores of investments in the next 5 to 6 years.
Wow.
That is the amount of infrastructure that is getting built in India. Just roads and solar require 3 lakh crores of capital to be pumped. Currently, who's putting this money? I think a lot of foreign investors are just fortunate. They've seen this evolution curve play out in the US markets.
Yeah.
In the last 10 years, Nitin, large foreign investors like Actis, GIP, where Abhishek, who is the fund manager of the strategy, actually comes from,
Right.
KKR, Brookfield, they have put $50 billion in core infrastructure operating assets. They've already done this. They've put money into assets which are running, which are fully operational. They've packaged those assets, then they've sold those assets or are holding them to maturity and generated 18 to 20% IRRs on an actual basis. Can you believe this? This has been happening in India at a size of $50 billion. But these are foreign investors doing it for foreign clients. We at Neo want to do the same thing in proven sectors where this opportunity is massive for domestic clients.
Right.
So we want to offer a unique saving product to our clients. As you rightly said, it's mezzanine debt. But in essence, in my simplistic world, it's putting money into great assets which are generating cash flows, where your counterparty is the government of India, and where potentially you have a chance to make 18 to 20% estimated returns by buying these assets and holding them. So yes, that's the motivation, and that is what excites us. At Neo, we want to deliver products, where we can channelize savings of our country into some of these assets. I keep telling this, Equities is an asset class. I think foreign investors came into India early, 95 to 2005, 2006. Post that, this is a domestic market. 2006 to 2020, I think the entire SIP movement, I think domestic savings is getting channelized into equity. I see similar shades of reference between credit and what we are doing to equities. 2012, 15, 20, a lot of foreign capital has been coming into these sectors, right? Because they're seeing these opportunities, they're seeing India is evolving. Our regulatory landscape is evolving. They've been there for the last 10 years. And now at Neo, we want to be the forefront of channelizing domestic savings into some of these strategies. This is the SIP moment in my view. And I'm hoping we can be the torchbearers in that.
No, absolutely, you're right, because you are literally talking about democratizing infrastructure assets for individuals and stuff like that. Would be lovely to hear about maybe a couple of case studies on this fund and how you exactly aim to go about it.
Absolutely. So as Nitin said, I think what we are trying to do in this fund, which is the Neo Infra Income Opportunities Fund, it's an income generating fund. It generates 8 to 9% interest dividend on an annual basis to investors. So it gives you regular cash flows. And on a 6-7 year basis, we are trying to generate total returns of 18 to 20%. Let me give you, so we are doing privately listed InvITs. A lot of you are familiar with InvITs, have invested in a PGCIL InvIT, which is a publicly listed InvIT. We are doing a privately listed InvIT. For example, there is currently the NHAI. The government itself is monetizing road assets, right? NHAI is the government's body for monetizing road assets. NHAI has a privately listed InvIT, which is largely available to institutions.
Correct.
It's a beautiful piece of asset, and typically individuals cannot own that asset. We as institutions can own that asset. Currently, a lot of Canadian investors are owning that assets. A few insurance companies in India are owning that assets. It basically is a pool of operating road assets, which the government is selling. You get a chance to buy that at an entry IRR of say 12.5%, Nitin, which is supremely healthy. The government here is your counterparty. And then the very fact that this InvIT is still privately listed, there are several benefits that will play out.
Right.
3 benefits if I can highlight. Obviously, the InvIT will add assets. That itself will get growth. So your IRR goes up from 12.5 to maybe a 13.5. The second bigger benefit is, currently the InvIT is only 50% levered. In India, InvITs can lever up to 70%. 70%, yes. So when you acquire more debt and acquire assets, your IRR actually bumps up even more.
True.
So that will give an even bigger fill up to IRR. Third is from a governance perspective. In an InvIT, the most important thing is who is the sponsor of the InvIT. Here, the government of India is the sponsor. We are extremely comfortable with that. Anybody should be, right?
Yes.
And the most important thing is currently this is privately listed. Tomorrow it might become publicly listed. Private to public, we all understand that there is a capital appreciation that plays out, right? Because the hands of ownership change.
Yes.
And which is why there is a lower discounting. So there is a high degree of making capital gains on this. The other thing is you are entering a road InvIT which holds assets of 20 years in duration. Just simplistically, Nitin, think of it. You are entering a 20-year bond. It's not a bond, it's a mezzanine debt.
Yeah.
At 12.5% IRR, where the duration is, where the maturity is 20 years. Tomorrow, if interest rates go down by 100 bips in the next 3 years, 4 years, 5 years, and we don't want to be in that forecasting business, you will make huge capital gains on this. So our view is it's a great asset to own. Government of India is the sponsor. We can estimate it makes 16-17% IRRs by just owning this access and providing access to our clients through our funds to own these assets, right? Let me give you another example. I think you wanted one example of where we are trying to buy an operating road.
Yes.
So we are, the number one bidders on one of the road projects. We've been at that road for the last 3-6 months. It's a beautiful stretch of 27.5 kilometers. It's an operating road. We are buying that asset at an estimated value of somewhere between 180 to 190 crores. I'm not giving the exact numbers. The beauty is that that asset is already generating revenue of 50 crores a year. 50 crores a year, cash flow. Who is your counterparty? NHI, right? You buy this asset, and if you put these numbers on an Excel, right? If you put this revenue, you deduct the expenses, and you take the cash flows, right? Obviously, it will be funded through a combination of our fund capital and cheaper capital from banks, because in banks you can get debt against operating projects, right? Typically 2:1 debt at close to 8% on an operating project. The combined IRR could be as high as 20 to 21% IRRs. And this is on an operating road. Conceptually, Nitin, what are we trying to do? We are trying to buy assets from developers, from the government, at close to 10.5 to 11.5%. Just think of it. Earlier, investors were buying buildings and flats at a rental yield of 9, 9.5. Then you went and did a LRD with a bank at close to 8. 2:1, you got leverage. Your returns bumped up by 2% to 11, 11.5, and then you made capital gains. It was a physical asset, generating cash flows, good, healthy returns, right? We are now replacing a building with an operating road asset,
Right.
where the opportunity is even bigger, even sweeter. We are buying it at 11%. I go to a bank, I tell the bank, NHI is your counterparty, give me leverage. Infrastructure projects, 2:1 leverage is a very, very healthy norm. You get leverage at 8, you're earning this spread of 3%. That spread is no longer left in commercial property. So here you have an asset at 11, acquired from a developer. Why does the developer have to sell it? Because his balance sheet cannot hold this for the longest period of time. They have smaller balance sheets, right? So here you buy it at 11, you do the leverage at 8, 2 times, spread of 3, benefit of 6, 2 into 3. So you reach at 17% IRRs. Once again, 17% IRR, great asset, 15-year asset. Tomorrow when we sell this at 13, 12, 14, we will make capital gains. And that's how your combined returns move to 18 to 20% IRRs.
Right.
The good thing is, in my view, these, once again, it's built on the premise of providing long-term capital. And that's where cost of capital advantage comes. You buy from a developer whose cost of capital is very high. We are buying it at a discount from him, and then we are going to do an InvIT out of this or sell it to strategic investors. Right. So we are moving from the cost of capital chain, and that is how we are adding value. As I said, fundamentally, the act of putting money should generate money first.
Now, clearly, I can see, Hemant, that you and your team have enough and more technical expertise. And also, as you rightly put it, the common sense to kind of put it all together into a strategy, which is mezz debt. And you have those superior skills to underwrite credit-oriented kind of assets. So fabulous to learn about this. It's been lovely talking to you. Thank you so much for your time, and wishing you all the best.
My pleasure, Nitin, and thanks to the entire team at Motilal Oswal and to you especially for inviting me to do this. Pleasure to talk to all of you and all the viewers today. Thank you.
Thank you.